morning, America. You are listening to the Financial Quarterback Radio Show with Josh Jalinski. This is Ernesto Caleri, his loyal sidekick. This morning, we have an amazing guest. He is an economist and a best-selling author. His name is Harry Dent, and his book is What to Do When the Bubble Pops, Personal and Business Strategies for the Coming Economic Winter. Harry, good morning.
Oh, nice to be here.
I'm glad to have you this morning. Josh is running a little late. You know, when you have 6 kids, I don't know how he does it. He and his wife, they're both saints. They're making America great again. So, Harry, give us a little background on yourself, and please give an introduction to your book. This sounds like an amazing book that America needs to read.
Yeah, actually on Amazon, my current book is 0 Hour. That's the best book to get. You know, the other things are my audio tapes and stuff. And basically, I'm a non-economist, okay? I did not, I started out, I graduated from Harvard Business School and worked for Bain & Company, consulting to Fortune 100 companies for a couple of years, and kind of got bored with big companies and started doing the same type of strategic consulting to new ventures and small growth companies in California. So I moved to California. I started managing companies and consulting to companies. And that's when I learned economics in the real world. So I'd taken everything in business but economics, all the marketing, management, accounting, finance, and the required economics courses. But the courses I was least interested in college and school was economics, because it's like worthless stuff. It doesn't relate to the real world and real stuff. So am I consulting to my clients, which increasingly became small growth companies, in other words, the new economy emerging back in the 80s, I had to have tools to help them see the future and changes in the economy. And over about several years, I developed my own economic indicators, which are totally different from what economists learn in economics. We look at people. People do predictable things as they age, like spend the most money at age 46 or 47 today, save the most money at 63 to 64 just as they go into retirement, and everything in between, apartments up to life insurance. I mean, there's 600 categories I can pull out of the U.S. economic surveys done every year and tell you exactly when people spend money on different things and all this sort of stuff. And I also look at the other important side of the economy, among many, but technologies change how we work and live. And technology, generations come with these spending cycles about every 40 years. New technologies like automobiles and electricity or computers and the internet, that sort of stuff, come about every 45 years. So I can take these cycles and show people any country in the world, any consumer sector in any country or economy, when there's going to be booms and busts and favorable trends and unfavorable trends over the rest of the lifetime. I can tell we're about to see the greatest economic downturn of our lifetime, something the government's been putting off with massive, crazy massive stimulus for years now. We're about to see the worst we're going to see in our lifetime, something I've been warning about for years. But I can tell your kids and grandkids when they'll see the greatest booms or a crisis like this when they grow up decades from now, because people are that predictable and technologies are that predictable. There's a lot of things that aren't. Economists focus on all the political stuff, which actually is harder to predict. Who's going to be president 4 years from now? What they're going to do, blah, 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 blah. The long-term trends are far more predictable than people have been led to believe. And that's what I've spent my life studying. And I just find more things every day that are predictable. And we are due for, we've been in a slowdown economically since late 2007, something I predicted back in the early to mid 80s when I came up with my first economic tools, these spending wave cycles of generations. And that's why we've been living off of endless quantitative easing, printing money and stimulus to offset this slowdown. Instead of taking our medicine and restructuring debt and doing all the things you should do to get productive and stronger, we're getting weaker by paving everything over with free money and causing the greatest speculative bubbles in real estate and stocks ever. And Ernesto, it's real quick, real easy. Bubbles only do one thing in history, and I've become an expert in bubbles in the last 10 to 15 years because we're in the greatest bubble period in history. Bubbles burst, and they never have a soft landing. There are no soft landings to bubbles, and this bubble is the most global. It is everything. It's been commodities. It's even in gold today. It's in real estate everywhere. It's in stocks the most. And you know the biggest bubble right now is? Just guess. Bitcoin. Bitcoin is the beginning of something big like the dot-com stocks in the late 90s, but it is in a bubble that is going to burst 90 to 95% probably in the next few years, and stocks are going to see a bigger crash than anybody's warning. And this, if you look at my indicators and you look at history, this is not a guess. This is inevitable.
So, Harry Dent, you've heard it here first. This is Josh Jalinski, the financial quarterback, warning us that Bitcoin bubble may pop. What about those who say, Bitcoin's going to hit 100,000 before it crashes?
That could happen. That could happen first. I've been predicting that Bitcoin would see another strong surge in 2021. Now I'm questioning whether it just was over at 62,000 or whether it is going to go up to something like 100,000 or higher. I can tell you one thing with a high level of confidence: Bitcoin will not. The present Bitcoin bubble, which has taken it up 3 to 4 times in just months, will not last past the end of this year. And I think it probably has now peaked. And it's a leading sign because Bitcoin, like the dot-com bubble, do people remember when AOL, which was a substantial company, but still small compared to
no, but AOL,
internet company,
in a lot of ways,
400 times earnings in March of 2000?
That's a great parallel. Could Bitcoin
be
the AOL of crypto?
Amazon, the leading internet company today, went up to 136 in that bubble and crashed to $6, even though it was the leading internet company then and is the leading internet company retailer today. It crashed that much. This is what happens in my 45-year new technology cycle at this stage, early stage emergence of Bitcoin and crypto and blockchain technologies, which are in their infant stage. They're 1 to 2 years old, Josh, okay? That's where the dot-coms were in 1999, 2000, when they bubbled up, burst 95%, including Amazon, and then had the greatest boom in history to follow in technology stocks. So I see Bitcoin and blockchain like the internet stocks on a 20-year lag, and they're about to head for a crash. Bitcoin is probably going to go back to 3,000 to 4,000, and then I would load up on it. And then I'd buy companies like Rhino, real estate applications, and Ripple, and things that have real blockchain applications in the financial world. People need to understand. People do not understand Bitcoin and blockchain. What it is it's the internet for financial assets and money. It's the digitization of all financial assets, and that's where the value is. Bitcoin has no value today except that it might become a gold-like standard for that digital money system, but it is nowhere near that now. And anybody thinks that Bitcoin is a safe haven when this bubble crashes is going to get a rude awakening. It will be the biggest crash of all of them. 95%, I'm predicting.
Wow. So you've heard it here first. Harry Dent
going
out on a limb. So it's not that you think the blockchain technology isn't here to stay. You just think Bitcoin's in a bubble.
Yeah, it's the next big thing. It would be the number one sector, including nursing homes and aging sectors for baby boomers and a lot of things like that. And globally, India and Southeast Asia are going to be the next big Asia boom. No longer, China will never lead growth again. And neither will Japan or South Korea. East Asia is done. China mostly, the rest of East Asia done. So India, Southeast Asia will be the place to be. Aging sectors.
Why is that? Why is that? Because of the forced abortion policy of the Chinese? So that's not where the population growth is? Because I know you're big on demographics.
Yes. Yes, demographics is the most predictable thing in our economy, and economists don't even have a course in demographics, nevertheless know it from you-know-what, okay?
Yeah, so I should get the stimulus. Having 6 kids, Harry, I should get the stimulus.
You should get the stimulus.
But I get no
This is
stimulus.
what causes our economy to grow.
Children.
We have not been having kids. We peaked in having kids in 1961.
And that's why there's utter stupidity. And by the way, that's why Bill Gates and those who push population control are stupid. It's just outlandish.
It can make sense in poor countries and stuff, and it can make sense for people in disadvantaged states. But no, it doesn't. No, that's right. If you do not, first of all, you have to have 2.1 kids on average per household just to replace the last generation with the next generation, and your economy be at the same level. It's only above that you actually grow. We never had that problem until after 1961 when births peaked forever in this country, and they came back near those levels in 2007, 1990 and 2007 with the millennials and zillennials. But the next generation will never require us to have more houses and more infrastructures and a bigger economy because we didn't have kids. In countries, what happens historically, and this is also predictable, I can predict when third world countries will reach the same thing. As we urbanize and get wealthier in GDP per capita, we have less kids. We want to have fewer kids and send them all to Harvard. That's what everybody's dream is. Have 1 or 2 kids instead of 6 like you and get them all into Harvard. And that's what people do. And when you start having 1 to 2 kids per family instead of 3, 4, 5, and 6 like you, and in the past with the baby boom, economies slow on a predictable.
So we need another baby boom. Instead of make America great again, make America boom again, right?
Well, we do, but I'm telling you, Josh, that's unrealistic. We're already so wealthy, and so is Japan.
We're lucky if we have 2.1, and the only reason we have 2.1
immigrants. That's the realistic way, a mature country, and we do a very good job of that, and so does Australia, New Zealand, and some European countries. You attract the best immigrants in the world who want a better life from third world countries. And that's, I'm telling you, trying to get people to have 3 or 4 kids, Josh, I don't know. You could give them $10,000 for every kid and they still wouldn't have them because it costs $300,000 to raise those. So that's $1.8 million bill for you.
It's probably a lot more than 300,000 when you.
Well, that's average.
Yeah, when you
that's
chalk
average,
up.
And that's not counting college.
Yeah, this is a fun discussion with Harry Dent. We're going to ask him up next, when does he see the market at its zenith? He's a cycles guy. We've had Stan Harley on who says, maybe 12 months from now, the cycle was protracted. I think Harry's a little more bearish than Stan. So he is the author of 0 Hour. Is that your latest book, Harry?
Yes.
0 Hour, which will give away.
Latest book.
Which will give away to those of you who schedule and keep your no obligation review. Up next, this is Josh Jalinski, the financial quarterback. Hey, we're back. This is Josh Jalinski with Harry Dent, best-selling author. So, Harry, you think we're in a bubble. I mean, we all know we're in a bubble. It's just a question of when it'll pop.
You don't think we're in a bubble, you're blind. But most people don't think we're in a bubble, by the way, Josh. And most economic experts don't think we're in a bubble yet.
Yeah. I mean, the thing is, are we at 98, 99, or 2000? This bubble resembles, in some ways, this is the mother of all bubbles. You have a government debt bubble, a Bitcoin bubble, a real estate bubble now with COVID, a stock market bubble. And in some, I fear the mother of all bear markets is coming, but when? It's a fool's errand to exactly time perfectly, but do you think it's 12 months? Do you think it's 18 months? Do you think it's steep?
No, I do not. I love Stan. I do not agree with Stan on this. I do not think it's that far out. It could be with this much stimulus. This peak would have naturally and should have naturally come, particularly on the 90-year and 45-year technology cycles, which are what correlate with bubbles. The demographic cycle doesn't cause bubbles like the technology cycles do at certain stages, like now. This bubble should have peaked in late 2019, early 2020. So when the COVID crisis hit, we first went down. That should have been it. Now, we all know what happened. They've been stimulating. And you got to ask yourself, how weak can an economy be to have nonstop escalating stimulus for 12 years now and still only grow at 1.65% on average and 2% at best? What happened was COVID took us down hard. That was an external factor in an already weak economy, but they put in, now listen to this, now we're up fiscal stimulus since COVID, $5.1 trillion with a new $1.9 trillion plan, on top of $3.8 trillion in monetary stimulus, on top of trillions before that, but just in the last year. So up to $9 trillion in stimulus, 44% of GDP, just to get us out of this COVID hole. And we're still only growing so fast. And I don't think this growth is going to last. I think people have refinanced their home 3 or 4 times now, traded over to a better home 2 or 3 times, bought the best car they're ever going to dream of, got all their kids in college if they can. And I just don't think, I think they've been overstimulated so long that we don't have as strong a recovery as people think. And I've got a very simple chart, and it's the best pattern in that you can find in chart patterns. It's called a megaphone pattern. And ever since the late 2017, early 2018 top in Bitcoin at first and in stocks, first big bubble top, we've been making higher highs and lower lows because we've got momentum and bubbles and stimulus from the past, but we do have weakening demographics, rising debt and financial assets, all weighing on this. And so every stock crash takes us to a lower low, and that's been happening since 2018. The next stock crash projected by this model, and it looks ripe to happen, start any day now, it would take us to 2,100 on the S&P 500. That would be 48% lower than recent highs, 48%. Now, if we have that sort of stock crash, and that's what I'm looking at in the next 2 to 3 months, okay, and starting probably by late April would be my best estimate. I think this has a little ways to go up yet, but not a lot. If you get that sort of stock crash and we go into another recession after $9.1 trillion of stimulus, people are going to finally wake up and say, oh, something's wrong here. This economy's dead. We've pulled out the defibrillators time and time again. You watch the emergency room and hospital shows, right? You get people in, they do the defibrillators 5 or 6 times, and then they pronounce them dead. This economy is dead. I am telling you this. It is just common sense to realize that if it takes $40 trillion in global stimulus and 9.1 just in the U.S. in the last year to keep this dead economy barely alive, then it's dead. And you better get out of the way. You better get out of stocks and real estate, because when this next bubble crash happens, it's going to be the fastest yet, and real estate's going to join stocks this time. So you bet, and real estate's a lot harder to get out of than stocks. So you better be selling real estate as fast as you can that you don't need, and I'd be getting out of stocks. My target's about 4,100 on the S&P 500, maybe 5% higher than here, and by the end of April, if not sooner.
Yeah, I do see that we're due for some correction late April, early May, and with some of the cycles work pointing. I believe we're in the mother of all bubbles, and we'll probably have the mother of all bear markets within the next couple of years. People don't realize what's coming. I think we do not know the extent of the funny money, though. We had no clue. I mean, I thought the mother of all bears was happening last year. A lot of people did. And then all of a sudden, and you probably know this, what did the Fed do? The Fed did something brilliant, by the way. They usually don't do anything brilliant, but they did something brilliant here. They lent money to the corporate bond market. Bond ETFs were going... They were going to lose 80, 90%. They could not have any liquidity. And then they gave emergency funding powers. This was probably the least reported story. I mean, Wall Street Journal did like one expose on it. What research did you do on that? That was a pretty scary thing that happened, that nobody really understood what was going on.
It was a scary thing, and that happened before COVID. That was the first jolt in money They had been tapering policy. You know, the Fed's always, central banks keep telling us and economists, oh, we just had a crisis in 2008. We just got to get over this. We'll be back to normal. My indicators have said from the beginning, the economy demographically and debt and all this stuff only gets worse, and the pressures only get worse. We don't get over this crisis unless we do in every crisis. You cut back debt, you let zombie companies go under, and you don't keep a dead economy and dead companies going, which is what we're doing. We're just wrapping up debt and monetary stimulus to do that. So that was the first sign when I said in my newsletter, we're in trouble. The Fed says everything's okay, we can taper. And as soon as they taper a little bit, they had to print $700 billion, what you're talking about, just to save the banks and bond markets from collapsing, because they can't live without this stimulus. Everybody's on life support. We're in the emergency room, folks. We've been in it since late 2008 for over 12 years now. The only question is how long can you live off of artificial life support and stimulus that is not real and only pumps up financial assets until we've started to get fiscal stimulus. And now that's causing some inflation, which causes problems for bonds and stocks. At some point, this thing breaks. I can tell you one thing with 199% certainty, Josh, a bubble like this only ends one way, with a big bubble crash. There is no other precedent in history. Once a bubble, I don't care what, China's trying to taper their bubble now. I don't care what you do now. When this bubble finally bursts, it's going to be nasty. All I'm telling you, there's nowhere to hide. Bonds, except for high-quality treasury bonds, all go down because of credit risk. Stocks collapse the most. Real estate goes down with a lot of debt against it, which makes it the most dangerous, even though it maybe go down 40, 50%, while stocks go down 80, 90, and Bitcoin goes down 90 to 95, okay? But everything goes down. You have to get out of the way. You cannot listen to the typical economist that says, which is the right advice 90% of the time, oh, just sit through the correction and rebalance your portfolio. Not this time. This is a reset of the entire boom since 1983 with the baby boom and the greatest bubble in history, and there is only one way it ends in my cycles, and Stan would agree with me on this cycle. Late 2022 is a major low of our lifetimes. I've been saying since the 1980s that the stock market would probably be at the lowest point in our lifetime at the end of 2022, and now that we've pushed this off another year, it might be 2023. But I'm telling you, this reckoning is very likely to come in the next 2 years. You cannot steer through it. You got to get out of the way, give up some gains for a few years, and even if the stocks go up another 5 or 10%, get out. And when this crash happens, the world's going to be your oyster. You can be like Joseph Kennedy. He got out in 29 when the shoeshine boys were giving him advice. He said, oh, he wasn't an expert on the markets either back then, but he was a rich bootlegger, and he was a damn near criminal, by the way. He used that crash, getting out and getting back in and buying businesses and stocks 80, 90% off. He transitioned from being a multimillionaire to a billionaire and political dynasty by playing that crash, by simply getting out of the way and reinvesting systematically after the reset happens.
What about...
Then you can get back into asset allocation and stuff.
Okay, so man, it's already 30 minutes. It's been fast hour. Lightning fast. Harry's had a little too much espresso this morning, but that's great it's a lot of fun. So I'm going to ask Harry the question everybody always asks him. You're always negative. You're not always negative.
No,
if people
Josh,
really
no.
I know.
The first 2/3 of
no,
my
I know
career,
that you were.
You say that you don't understand nothing about me.
Yeah, no. No, I'm aware of that. But that is the knock on you.
You're not aware. You wouldn't have said that if you were aware of that.
No, but that's
Could you not be negative after the
critique.
Bubble in history?
So we'll talk about that. We'll talk about that up next. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
The preceding program was is sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.